Let's start with the elephant in the room. It is frustrating. I know it is. You look at your portfolio. You look at the news. Gold is smashing through $2,400, $2,500. It is capturing headlines. Central banks are buying gold by the ton. China is buying it. Russia is buying it. Costco is selling gold bars, and they are selling out in hours. And then there is silver. Silver is the volatile, unpredictable, frustrating little brother. It sits there. It chops sideways. It rallies for 3 days and crashes for 5. If you have held silver for the last 3 years, you have likely felt a mix of boredom and anger. You have watched tech stocks go to the moon. You have watched crypto create millionaires overnight, and your silver stack is just gathering dust. But here is the secret that Wall Street smart money knows, and the average retail investor misses. The time to buy is not when the asset is on the front page of the New York Times. The time to buy is when investors have capitulated, when people are tired, when they have given up. That is where we are right now. The sentiment in the silver market is absolute apathy. And historically, apathy is the precursor to a violent explosion to the upside. Let's look at the cold, hard data. We have to strip away the emotion and look at the supply and demand mechanics, because something is breaking in the physical market. For the last 3 consecutive years, the world has consumed more silver than it has produced. This isn't a minor rounding error. We are talking about massive structural deficits. In 2022, the deficit was nearly 240 million ounces. In 2023, the numbers remained grim for supply. We are seeing a market that is literally eating its own above-ground stockpiles to survive. Think about what that means. Every single day, the vaults in London and New York are being drained. The COMEX, which is the primary exchange for silver futures, has seen its registered silver inventories, the metal that is actually available for delivery, plummet to dangerous lows. We are not talking about a dip. We are talking about levels we haven't seen in years. So why isn't the price reflecting this? Why isn't silver at $50 or $100? That is the billion-dollar question. And the answer lies in the battle between the paper price and the physical reality. The price you see on your screen is largely determined by futures contracts. These are paper promises, traders betting on the price direction without ever intending to touch a bar of silver. For years, this paper market has absorbed the demand. It has masked the reality. But you cannot build a solar panel with a paper contract. You cannot build an electric vehicle battery with a futures slip. You need physical metal. And that is where the story changes. We are entering a new industrial age, and silver is the blood running through its veins. This is the part of the thesis that most old-school investors miss. They think of silver as money, and it is money. We will get to that. But today, silver is a strategic technology metal. Let's talk about solar. The photovoltaic industry is exploding. Governments around the world are mandating green energy. They are printing trillions of dollars to subsidize it. And you know what you cannot have without silver? A solar panel. Silver is the most conductive metal on Earth. It is non-negotiable for efficiency. Newer solar technologies, specifically the TOPCon and HJT cells that are taking over the market, use significantly more silver than previous generations. We are not using less. We are using more. The solar industry alone is on track to consume 20%, maybe even 25% of the entire annual global supply of silver. Just one industry, 1/4 of the supply. Then you add in the automotive sector. Electric vehicles use almost twice as much silver as internal combustion engines. Every sensor, every chip, every connection in a modern car requires silver. Then you add in the AI revolution. Everyone is talking about NVIDIA. Everyone is talking about data centers. What do you think connects the components in high-performance computing? Silver. We are facing a scenario where industrial demand is becoming inelastic. That means companies like Apple, Samsung, and Tesla don't care if silver is $25 or $50. They need it. If silver goes to $50, it adds pennies to the cost of an iPhone. They will pay it. They have to pay it. This creates a floor under the price that didn't exist in 1980 or 2011. If you are following the logic so far, and you see the supply squeeze coming, take a second to like this video. It helps us get this data out to more people who need to wake up before the price moves. Now let's pivot to the monetary side, because silver is a hybrid. It is an industrial metal, yes, but it is also monetary history. The gold-silver ratio is perhaps the most reliable indicator in the history of precious metals trading. Simply put, this ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio sits around 60 to 1. In the ground, geologically, it's closer to 19 to 1. Today, as we speak, it is hovering in the high 80s, sometimes touching 90. When the ratio is this high, it screams one thing: silver is cheap relative to gold. When the elastic snaps back, and it always snaps back, silver outperforms gold by a massive margin. If gold stays exactly where it is right now, and the ratio just returns to its historical average of 60, silver has to jump 50%. If the ratio goes to 30, which it has done in past bull markets, silver triples. And that is assuming gold doesn't move. But we know gold is moving. Gold is sniffing out the devaluation of the currency. We have to talk about the macro economy. We are living in a world of $34 trillion of U.S. debt. Interest payments on that debt are now exceeding the defense budget. The Federal Reserve is trapped. If they keep rates high, they break the banking system and the commercial real estate market. If they cut rates, inflation roars back. History tells us there is only one way out for a government drowning in debt: financial repression. They have to let inflation run hot to inflate away the debt. They have to debase the currency. When the dollar loses purchasing power, where does capital hide? It goes to hard assets. Real estate is unaffordable for most. Stocks are at all-time high valuations. Bonds are losing value in real terms. Gold is the first mover. It is the king. The big central banks and the sovereign wealth funds move into gold first. We have seen that happen over the last 18 months. But once gold gets too expensive, or once the public finally wakes up to the inflation reality, the money trickles down. It flows into the poor man's gold. It flows into silver. The silver market is tiny. It is microscopic compared to the bond market or the stock market. If just 1% of the capital currently sitting in U.S. Treasuries decided to move into silver, there isn't enough metal on the planet to satisfy the orders. The price would not just rise, it would gap up. You would wake up one morning and silver would be up 10%. The next day, another 10%. This is what happened in 1980 with the Hunt brothers. This is what happened in 2011 when silver nearly touched $50. The moves in silver are violent. They are fast, and they wait for no one. This brings us to the psychology of the rebound. Why hasn't it happened yet? Because markets inflict the maximum amount of pain before they reward the faithful. We have been stuck in a consolidation phase. Consolidation is boring. It shakes out the weak hands. The tourists who bought silver hoping for a quick buck have already sold. They sold at a loss and went to buy AI stocks. Who is left? The strong hands. The people who understand the fundamentals. When the selling pressure exhausts itself, there is no one left to sell. And that is when the buyers step in. But there is another factor, and we have to address it because I see it in the comments all the time. Manipulation. Many of you believe the price is suppressed by the big bullion banks. You look at the fines J.P. Morgan has paid for spoofing. You look at the massive paper shorts, and you are right to be skeptical. The paper market has been the tail wagging the dog for a long time. However, manipulation has a shelf life. It only works as long as there is physical metal to back up the game. When the physical vaults run dry, the game ends. We saw this with palladium a few years ago. The shortage became real, the paper shorts got squeezed, and the price went parabolic. We are seeing signs that the COMEX is under stress. We are seeing premiums on physical coins detach from the spot price during high demand. If you tried to buy Silver Eagles a year ago, you remember the premiums. That was the physical market telling you the paper price was a lie. So, let's paint the picture of what the rebound looks like. It usually starts with a catalyst. Maybe it is a geopolitical flare-up that sends investors rushing to safety. Maybe it is a sudden weakness in the dollar index. Maybe it is a report showing a massive shortfall in mining production. Mining, by the way, is a disaster. You cannot just flip a switch and get more silver. It takes 10 years to bring a new mine from discovery to production. 10 years. And right now, mining grades are falling. The easy silver has been dug up. We are having to dig deeper, process more rock, and use more energy to get the same amount of silver. The cost of production is rising. This means the floor price, the price below which miners simply stop mining, is moving up. Downside risk is becoming limited because if the price drops much lower, mines close, supply drops further, and the price shoots back up. It is a self-correcting mechanism. But the upside? The upside is uncapped. Imagine a scenario where the Federal Reserve announces they are pivoting. They restart QE. They print money to bail out the system. The dollar drops. Gold shoots to 3,000. Suddenly, the mainstream media starts talking about hard assets. The retail investor, the guy who missed the move in gold, looks for something cheaper. He sees silver. It looks affordable. He buys. Then the industrial users panic. Samsung realizes they might not have enough silver for next year's production. They start stockpiling. They stop buying just in time and start buying just in case. Then the short sellers, the hedge funds betting against silver, get trapped. They have to buy to cover their positions. But there is no liquidity. Every buy order pushes the price higher. This is the short squeeze scenario. And in a market as small as silver, it is like trying to push a camel through the eye of a needle. The explosion is vertical. I want you to think about your own position right now. If this scenario plays out in the next 6 to 12 months, are you positioned for it, or are you waiting for confirmation? The problem with waiting for confirmation in the silver market is that by the time you get it, you have missed the first 30% of the move. You end up chasing the price. I am curious, do you currently own physical silver, or do you trade it through ETFs? Or are you sitting on the sidelines waiting for a dip? Let me know in the comments. I read them, and I want to know where your head is at. Now, let's talk about the risks. We have to be adults here. This is not a get-rich-quick scheme. Silver is volatile. It can drop 20% in a month. If we have a massive deflationary crash, a 2008-style liquidity crisis where everything sells off, silver will sell off too. In a panic, people sell what they can, not what they want. Gold usually holds up better in that initial shock. Silver gets thrown out with the bathwater. But, and this is a huge but, in those scenarios, the response from central banks is always the same: massive stimulus. And the rebound out of that liquidity crisis is where silver makes its gains. We saw it in 2009. We saw it in 2220. The crash happens, the money printer turns on, and silver goes vertical. So even the worst-case economic scenario eventually leads to the bullish case for silver. The road might just be bumpy getting there. There is also the risk of technological substitution. People ask, what if they find a cheaper metal for solar panels? Scientists are trying. They are using copper where they can. But there are physics limitations. Nothing conducts electricity like silver. To reach the efficiency goals of the Paris Agreement and the net zero targets, you cannot compromise on conductivity. Substitution is slow, expensive, and inferior. For the next decade, silver is locked in. We are also seeing a geopolitical shift. The BRICS nations, Brazil, Russia, India, China, South Africa, and their new members, are accumulating real assets. They are trading outside the dollar system. They understand the value of commodities. China is the world's largest producer of solar panels. They know exactly how much silver they need. Do you think they are going to export their cheap silver to the West, or are they going to hoard it for their own strategic dominance? The East is buying. The West is sleeping. If you look at the charts, we are building a massive cup and handle formation that goes back decades. Technical analysts look at this structure and see a target that is significantly higher than $50. Some reputable analysts are calling for triple digits. Now, $100 silver sounds crazy to people. It sounds like hype. But adjust the 1980 high for inflation. If you use the real inflation numbers, the 1980 high of $50 is equivalent to over $150 in today's purchasing power. So $100 isn't a moonshot. It is simply silver returning to its previous value in real terms. It is the currency that has collapsed, not the metal that has spiked. So, is the rebound around the corner? The pieces are all on the board. 1. A historic supply deficit that is not going away. 2. Exploding industrial demand from green energy and AI. 3. A mining sector that has been underinvested in for a decade. 4. A gold-silver ratio that is stretched to extremes. 5. A macro environment of debt and debasement. It feels like the calm before the storm. The price action is boring, but the fundamentals are screaming. This is the divergence. Price is here. Value is here. Eventually, they must meet. The question is not if it will happen, it is when. And when it starts, it will be terrifyingly fast. If you are already holding, this is your validation. Stay the course. Patience is the hardest part of investing, but it is the most profitable. If you aren't holding yet, you might want to ask yourself why you are betting against the laws of supply and demand. Don't let the boredom shake you out of the trade of the decade. The spring is coiled. The fuse is lit. We are just waiting for the bang. If you found value in this deep dive, make sure you subscribe. We are tracking this market every single week, and you do not want to miss the update when the breakout finally happens. But knowing why silver is going up is only half the battle. You need to know what to buy. Should you buy bars, coins, ETFs, or mining stocks? There is a massive trap in the tax code and the premiums that can wipe out your profits if you buy the wrong type of silver. I've broken down exactly how to build a position without getting ripped off in this video right here. Click on that and I'll see you there.